Welcome back everyone, this is Mayank Kothari and today we are going to start a new chapter that's derivatives analysis and valuation. With this chapter we are going to step ourselves into the second volume of our syllabus. This chapter is very important and from the exam point of view I can say that around 8 to 20 marks of the questions can be asked from this chapter. 8 to 20 marks, okay, and that 8 to 20 marks will be 8 to 20 marks. So they can ask you 8 marks, 8 marks and 4 marks of the question. So this will be practical and theory. As far as I know, they can stick to 2 questions of practical and that too up to 16 marks itself. But if they want to extend it, they can also ask a theory question worth 4 marks. So yeah, the theory is also important. And my suggestion to you, since this chapter is little difficult than the previous chapter, my suggestion to you is before starting this chapter, please make sure that you have completed the theory part. You have completed the theory part from volume 3. At least one reading, though it doesn't matter if you understand that or not. I just want you to once at least complete a theory before starting this derivatives analysis and valuation. Now, what will happen and why I'm saying this? See, whenever I'm going to explain any concept in this chapter, I want you to get that concept very easily. Okay, and that is only possible if you have gone through the theory first. So you will be able to link some things that you might have read in the past while discussing the concept, right? So that's why I want you to go through the theory first before starting this chapter in the classes. Okay. Now, this chapter, Derivatives Analysis and Valuation, is an extension of portfolio management. What do you mean by an extension of portfolio management, sir? Are we going to use some of the concepts of the portfolio management in derivatives? Yes, sir. We are going to use few concepts only, and one of the major concept will be beta, equity share, and index. So these are some points that or concepts that we are going to take from the portfolio management. Nothing related to mutual fund or security valuation or security analysis will be there, but most of the part will be from the portfolio management. So again, we are like it's kind of a portfolio management extension that we are going to look forward to. But yeah, we are not going to calculate risk, return, standard deviation, variance. There are no major formulas in this. There will be only handful of the formulas, and the major focus will be on the concepts. Okay, so this is what I wanted to give you an introduction about. Now, let's first discuss about the concept of the derivative. In this entire name of the chapter, derivatives analysis and valuation, what do we actually mean by the derivatives concept? What is derivative? See, read once with me. A contract between two parties. What is derivatives? A contract. It's not an asset. It's not a mouse. It's not a mobile phone. It's not equity share. Not any commodity, nor any commodity. It's a contract. Simple. A piece of a paper, an agreement between two parties is called as a derivatives. So derivatives is not something that you will own. See, I own this mobile phone, right? I own this camera. I own this mic. I own this shirt. These are visible things, or we can say these are material things. But contract is just an agreement which starts at a point and ends at a particular point. So derivatives is going to be a similar thing. It will start somewhere, it will end somewhere, and the profit or loss between the two dates will be adjusted. So have a look once again. A contract between two parties. One party will be the buyer, the other will be the seller. To buy or sell certain asset in certain quantity on certain future date at a certain price. So basically what is happening is the two parties are coming together and entering into a contract where they are fixing today itself everything will be fixed. So what exactly they are going to buy or sell will be fixed today. In what quantity they are going to buy or sell that asset will be fixed today. At what particular date this entire exercise will happen will be fixed today. And the price at which this asset is going to be bought in this much of the quantity at this date will be fixed today. Everything will be fixed today, but for an exercise date of a future date. Exercise will happen on the future date. Okay. So why is this going to happen? Like, why people are going to do all the transaction, or why people are going to fix everything today if they have to do the transaction at a certain future date? I will just give you the reason for this in a moment. But now I think let's first focus on few things. We need to clearly understand the meaning here. Now, this contract that we are talking about is called as derivatives. Okay. Then this buyer of the derivative contract will be called as forward or futures buyer. This will be called as forward or futures seller. Okay, we'll talk about the forward and future also. Now there will be multiple assets. The asset which is being bought and sold in the entire transaction can be anything. But in our syllabus there are four major categories of these assets which we are going to trade. The first asset will be equity. That means buyers and sellers will understand. Buyers and sellers will come together and enter into a contract to buy or sell an equity in certain quantity. It can be equity shares of Tata Consultancy Services, ICICI Bank, Reliance Industries Limited, Adani Enterprises, Adani Power, Tata Motors, any company on which the futures are available or the forward are available. So you can enter into a contract to buy or sell equity shares of a certain company in certain quantity. So the quantity will also be fixed today of that how much we are going to buy or sell. And on a certain future date, are we buying this equity share today itself? No. So today we are entering only into a contract for buying or selling on a certain future date. Okay, why is this happening, sir? If a buyer has to buy or sell, if a buyer has to buy these shares on a future date, why don't he just come on that date and enter into a transaction? Why he is entering into a transaction today for a future settlement? I will just tell you the reason about it in a moment. Now, the other asset can be index. Let's take the examples of equity share. It can be TCS, it can be Reliance, it can be Tata Motors, it can be ICICI Bank as well. Okay. For the index, it can be Sensex. We will better take Nifty. It can be Nifty 50. Or we can say Bank Nifty. Mostly these are traded. Bank Nifty. So these are index which is also bought and sold in the derivatives market. You might see that index cannot be bought and sold in the spot market. Index constitutes different types of equity shares, but it cannot be bought and sold directly. But in futures, or we can say derivatives, we can buy or sell an index, because practically it's not the asset, equity or index that we are buying. In derivatives, we are buying a contract on equity, a contract on index. So when I say I'm buying equity shares and when I say I'm buying a contract on equity share, both the things are different. You buy equity share in the spot market or the portfolio management chapter that we had learned, that is called as the spot market and the cash market, in which you buy the security and own the asset. In this market, the derivatives market, you enter into a contract. That means you buy the contract or you sell the contract. You do not buy the equity share, you do not buy the index. It can be a commodity as well. You can enter into a contract to buy or sell any type of a commodity like gold, silver, bajra, rice. Yeah, these are the commodities on which you can buy or sell a contract. The last one which we are going to see is the currency, and this will be discussed by us in the forex chapter. So a part of the derivatives, not this chapter, but a part of the derivatives in our syllabus is taken in the forex chapter. So currency derivatives will be covered in the forex chapter. In this chapter, we are going to cover the equity derivatives, index derivatives and commodity derivatives, right? But currency derivatives will be covered in the forex chapter. Now, what currencies can be, like on what currencies we can buy derivative contract? It can be USD, it can be Euro, it can be let's say Japanese yen. There are many currencies. It can be Canadian dollar. There are many currencies on which you can buy or sell a derivative contract. So we'll discuss that in the forex chapter. Okay. So in this syllabus, in this chapter, our purpose will be restricted to the equity derivatives, index derivatives and commodity derivatives. Okay, I think to this point you might have got certain idea of what exactly we are going to do. Are we going to buy equity share in this chapter? No, sir. Are we going to buy index or a commodity? No, sir. We are going to buy or sell a contract on these assets. Okay, good. Let's move ahead. Quantity. Quantity will be called as a lot size. So let's say, for example, ICICI Bank has a lot size of 1374 shares. 1374 share constitutes one lot. That means if you want to buy a contract or a derivatives or a forward or futures, understand the meaning. Contract, derivatives, forward or futures. If you want to buy futures on ICICI Bank, you have to at least buy one lot or in multiple of that. That means you can buy 1374 shares at least and in multiple of that. That means you cannot buy 1372 shares or 2 shares or 3 shares or 4 shares. No, sir. Futures will not allow you to buy shares in small quantities. There will be a lot size. That means at least this much share and then in multiple of that. That means you cannot buy 1380 shares or 1385 shares. No, sir. 1374 and in multiple of that. This is called as a lot size. Okay. Then this date of a certain future date will be called as the expiry date. That means this is the last date of this entire contract. After this date, this contract will get over. After this date, this contract will get over. So till this date only the contract is valid, and after this date the contract will have zero value. Okay. The certain future price, you understand this future price, it will be called as, just a second. it will be called as forward price or a future price, or in a better wording we will call it as actual forward, or we can say futures price. This is the actual market price of the forward or futures contract or derivatives contract, you can say. So these are the basic meaning. By the time you solve the questions, now when you start solving the question, you will get to know about more of everything: buyer, seller, lot size, future price, expiry date, uh, more of all these things in detail. Now let's come to the derivatives part again. Till this point, you have understood a concept called as a derivative, which is nothing but a contract between two parties to buy a certain asset. An asset can be anything out of it. To buy that asset in certain quantity on certain future date on certain future price. This derivatives, there are 4 different types of derivatives, sir. Okay, understand the meaning of this. There are 4 different types of derivatives that we are going to discuss. And in this chapter, we are going to discuss 3 out of it, mostly. Okay. 1, 2, 3, and 4. First type is called as the forward contract. The second type is called as the futures contract. The third type is called as the options contract. And the fourth type is called as the swaps. So I was writing forward future there. Do you get it? This is the forward price, futures price, forward buyer, futures buyer. Derivative has 4 different types: forward contract, futures contract, options contract, and swap. We are going to divide this. Okay, let me just first write down. The fourth part will be mostly considered in interest rate risk management chapter. Mostly. Okay, apart from that, we will have forward, futures, and options also in interest rate risk management chapter. These 3 contracts right now we are going to cover in this chapter, which is called as the derivatives. Okay, I will take these 2 parts together itself. I will explain what is forward contract and futures contract, but in terms of the practical questions, we are going to take the practical questions together for the forward and futures contract, because everything for the forward and futures contract is same. An institute in our syllabus is not making any distinguishing between these two contracts. They are taking it in a simple concept, a same concept, and have solved all the question accordingly. So first we will focus on the forward and futures contract questions, and then we will start with the options contract questions. And after that, most probably the chapter will get over. So it's as simple as that. Okay. Now let's discuss about what is exactly the forward contract. Then we will go to the futures, and lastly options. Have a look. What happens to the transactions of forward contract? Let's say, for example, this is a timeline. Okay, and there is a stock. We will have to first decide the asset. Asset is, let's say, let's take a simple example of Adani Enterprises. Okay, and the current market price is, let's say, 100 rupees for the sake of simplicity. And you want to buy the stock, but you don't want to buy it today. If you want to buy it today, you can just go to the spot market and get the stock at 100 rupees. There is no other option. Okay. But you want to buy the stocks after 3 months because you think that you will have sufficient funds at that time to buy around 1000 stocks or so on. So the purpose is to buy the stock at a certain future date. That's cool. If that is the purpose, then we can wait for 3 months and then buy the stocks at this current market price, whatever will be the price. Today we don't know the price of that date. But if we wait for 3 months and then look at the price, we can buy at that price. The main problem is today that we are thinking that this is a good stock and in 3 months time it will go up, and our expectation is that the stocks will go up to 150 rupees in 3 months, and we don't want to buy at 150 rupees at that time. It's too much of a cost to pay for. What we can do today so that we can buy the stocks after 3 months at a lower price than 150. Is it possible? Because this 150 is not the actual price of the stock. This is just the expected price by us. We are expecting that after 3 months the price will go to 150 rupees, and we want to do something today itself so that we can secure ourselves and we can buy the stock at lesser price than 150. Okay. So what is going to happen? Now you will have to enter into, this is a spot market price, or you can say cash market price. If you want to buy the stock today, you can buy it for 100. But if you don't want to buy the stock today, and if you want to go and buy the stocks after 3 months, what you can do is you can enter into a contract on this date where you will decide the stock, which is Adani Enterprises. This is what you are deciding, asset. You will decide the quantity, let's say 1000. You will decide the price. You means the party, the other party who is going to sell you this contract. You are the buyer of this contract. That means you want to buy the stock. If you are the seller of this contract, you want to sell the stocks. So if you want to buy the stock, you buy this contract, and there has to be some other seller sitting somewhere in the country who is ready to sell the contract on these terms. And let's say both of you guys have decided the price of 130 rupees. Okay. The date, 3 months. You can clearly see that this is an agreement made between two parties, the buyer and the seller. You are the buyer. Someone else is the seller. He is agreeing to sell you the asset, which is Adani, in 1000 quantity at this price after this date. So everything is decided today itself, but for a future settlement. Today, it's the only contract that you have made. You don't have to pay anything today. Okay, in the forward contract. That's cool. I got it. Now, what happens is, why the seller is agreeing to sell at 130 rupees when the market price can go to 150. Let me tell you one thing. This is the price according to your expectation, and you are the buyer. You need to find out a seller who is thinking that the price will not go beyond 130 rupees, so that according to him it's beneficial for him, profitable for him to sell this contract at 130. If he is thinking that the maximum the price can go to is 120, then still he will be earning 10 rupees because he is selling you at 130 and maximum the price will go to 120. Today, the seller doesn't have the shares. You don't have the shares. Nobody in the buyer and seller of this contract has the shares. Both of you are playing on this price. Both of you are playing on this price. Okay, so this is a contract that you have made. This is called as the forward contract. Now, do you understand the difference between buying a stock today and buying a forward contract today? Buying the stock today means you are owning the share. First of all, you become the owner of the share. Here you don't become the owner of the share, you become the owner of the contract, which is going to expire after 3 months. That means this contract will not last forever. These shares that you buy in the spot market lasts forever unless and until you sell the shares or the company gets shut down. Okay. That is the major difference. Then second thing, you own the shares here, you do not own the shares here. You pay 100 rupees today right away when you buy the share. You don't have to pay 100 rupees or 130 rupees when you buy the contract. It is just a price at which you have decided to buy, not buying, decided to buy. So you don't have to pay anything today in the forward contract. Okay, sir. Then what is again another difference? Both the buyer and the seller doesn't own the share, is not required to actually own the share. If anyone is holding the share, if the seller is holding the share, then it's well and good, but no one is required to hold the share today. In this market, if you go and buy the share, the seller has to own the share, na? Otherwise he will have to borrow and then sell it to you. So basically he has to give you real shares in this case. If you go to the spot market or cash market, if you go to the derivatives market and buy a forward contract, you are just buying a contract, not the shares. That's the major difference. Okay. So this is what the forward contract is. Now what is going to happen? You have made the contract, the buyer has agreed, the seller has agreed, and now both of you will wait for the end of the 3 months. End of the 3 months, and both of you will get to know the actual market price. This was the market price expected by you. This was the market price expected by seller. But now after waiting for 3 months, you will get the exact market price, and let's say for example, the exact market price is 145. What will happen? See, the contract has to be settled. This contract will get over at the end of 3 months, and you wanted to buy the shares at 130. That means it will get settled at 145, and you will get a profit of 15 rupees. From the buyer's angle, this is going to happen. From the seller's angle, just imagine, he was ready to sell the shares at 130 after 3 months. Selling the shares means receiving the cash, 130. This was the selling price for him. That means he will have to buy the shares at 145 on that date. So practically speaking, what he is going to do, the seller, he will buy the shares at 145 and sell it to you at 130, and he will be at loss of 15 rupees. Okay, just a second. He will be at loss of 15 rupees. This is going to happen. You will buy the shares at 130 and you can sell the same at 145 in the market. But this is just for the purpose of understanding. We say that he is buying, he is selling and all that. Nobody on this date will actually buy the shares or sell the shares. Excuse me. What happens in reality is, in the derivatives market, you don't buy or sell the shares, you settle the amount. If you really want to buy the share, go to the spot market, pay 145 rupees. But sir, we agreed to pay 130 na? Exactly. The net cash outflow for the buyer will be 130 only. Just look at this. You will pay 145 in the spot market, and in the derivatives market you will receive 15 from the seller. So 15 is the profit, 145 is the outflow, 15 is the inflow. Net outflow is 130 only, and you still own the share because you have purchased it from the spot market. If you really want to own the share on this date or on this date or on any date, you will have to buy it at the spot price. Go to the spot market, buy the share. What will happen to the derivatives contract is it gets settled at the closing price. So if you wanted to buy, if you agreed to buy at 130, you can sell it at 145. Practically this will not be an outflow or this will not be an inflow. The only outflow and inflow will be this much. Okay. So instead of writing plus minus sign, I think in order to give a better idea about what will happen, I will just write down. See, This will be a buying price for you. This will be a selling price for you. This was the selling price for the seller, and this will be a buying price for the seller. So you can see the selling price is higher than the buying price. There will be a profit to you and loss to him. The loss will be paid by him to you. That is 15 rupees. That's it. The contract between the both of you was only for this purpose, to settle the cash flows. 15 rupees. You take those 15 rupees, add it to your 130, it becomes 145. You go to the spot market and buy the share if you really want to. Otherwise, go to home and enjoy 15 rupees. So this is how the forward contract works. Now let me tell you one thing. If you really wanted to buy the share, that means your purpose was not to gain from it. Your purpose was to restrict the amount of buying the share. You wanted that there should not be any risk. You wanted to take no risk on that date higher than 130. So the purpose was no risk, no loss. It should not be, we can say, bad deal for you by buying the shares on this date. So that's why you agreed in the beginning. So if your purpose is really to buy the asset and you want to reduce the possible loss or risk, then this guy will be called as hedger. There are three people who can take the benefits of the forward contract or the derivatives contract. There are majorly three people we will be discussing. The one will be hedger. The second one will be speculator. And the third one will be arbitrager. Okay. This guy, you will be called as a hedger if you really wanted to buy the share. That means you didn't want to take, you wanted to reduce the possibility of risk. Here the purpose is no risk, no loss, and no profit also. The purpose of the hedger is not to gain from the market, but to avoid losses if there is any. In this case, we really wanted to buy the share after 3 months, but we didn't want to pay a higher price, whatever will be at that date. And that's why we entered into a contract today to fix the price, which will be dealt in after 3 months. And what happened actually after 3 months is we bought the stock at a higher price of 145. We paid 15 rupees extra, but we got the same as a profit from the derivatives contract. So from our pocket, in order to own the stock, we only paid 130 in net. 145 here negative, 15 here positive, and the net cash outflow from your pocket is 130 itself. So that means you have avoided the possible loss of 15 rupees by a profit of 15 rupees in the derivatives market. So you will be called as a hedger. One thing. Second thing, let's say for example, the entire purpose of entering into this transaction for you was never to buy the stock on this date. It was just the possible gain that could happen, and that's why you bought the share. You had this expectation that the market price will go up only at 150 or certain price. So in the beginning itself, you fixed the price of buying this stock after 3 months in 1000 quantity at 130 rupees. What happened in actual is when the price actually went up, and according to your expectation, not to 150, but it went up, it still went up to 145, and then you hit the profit. You settled it at 145, and the profit at that date was 15. So what exactly is going to happen? You will have a cash inflow of 15 rupees only. There was no cash inflow in the beginning. There will not be a cash outflow and inflow in the beginning except for this amount. So you will receive 15 rupees and seller will have to pay 15 rupees. Both of you didn't own the stock at the beginning. Okay, and both of you had no intentions to own or sell the stocks in reality. Both of you were playing in this market. Both of you were playing in this market just for the purpose of gain. Obviously, when you take the risk, you will have the losses as well. The gain is also possible, the loss is also possible. So hedger was using this market to avoid the loss. Speculator means playing in this market for a possible gain. Speculator, if you are a speculator, that means you never wanted to buy or sell the stock. Purpose was to gain from the derivatives market on prices. This is where you take high risk and there are high profits. The hidden part in both the cases is if you don't take the risk, there will be no loss, but there will be no profit as well. So this is a hidden part. In that case, if you take the risk, the profits will obviously can go up, but the losses can also go to high profit, high loss. Okay. Next comes to the third part. Let's come to the third part. See, a same person can be a hedger, can be a speculator, can be an arbitrator. It depends upon what exactly is the purpose of buying the forward or futures contract or a derivative contract. Why a person wants to enter into a derivative market? What exactly is the purpose? And based on that purpose, you will decide whether he is a hedger or the speculator. He will be called as a hedger if the purpose is to reduce the loss. If the purpose is to gain from the market, that means you are a speculator, you are not a hedger. Okay, this entire transaction will be called as hedging if this is the purpose. This entire transaction will be called as a speculation if this is the purpose. Okay, now the topic is arbitrator. We will discuss about the arbitrator part later on because this needs some kind of a formula and so on. So this is the actual forward price. Arbitrator means what? A person who buys the item at a lower price and sells it at a higher price so that he can gain from the market, a small gain without any loss. So let me tell you one thing. Let's just write down. Finds an opportunity of price mismatch. Tries to buy cheap, sell high, so that he can have no risk, still little profit. Not high profit, but little profit. And no loss. There will not be a loss. Understand one thing. Arbitrator will not take any action if there is a slight chances of the loss. In this case, we can clearly say confirmed profit. In place of this little profit, we can also say guaranteed profit. If the profits are guaranteed, then only the arbitrator will take action. These will be then called as the arbitrage activities, arbitrage transaction. What exactly he is going to do, I will just explain you later on. In a summary, what I can tell you is this is the actual market price of the forward contract. What he will do is he will calculate the theoretical market price of the forward contract and then find out if there is any difference in the both. And if there is any difference, then there is a possibility that he can enter into certain transactions so that he can have certain gain, guaranteed gain from this market. In this market also arbitrage is possible. In this market also arbitrage is possible. The purpose of the arbitrager is always to find an opportunity of the price mismatch. 130 is the actual price. He will calculate what exactly should have been the price. If the price should have been 140, that is theoretical, and then the 130 is actually lesser than what should have been, he will buy the contract at that time cheaper. We'll talk about it later on. Okay, so do you understand the logic of the forward contract? Then comes the futures contract. What happens in the futures contract is because of the one problem that we can face in the forward contract. Now, what can happen in the forward contract? Please understand. Both of the guys, forward buyer and the seller, entered into a contract today. Okay, let's say these guys entered into a contract. This is the buyer, this is the seller. Okay, they entered into a forward contract, but at the end of the 3 months, what if looking at the losses, seller denies to pay this? Seller in practical life, let's just understand, seller is not agreeing to pay this amount, seller is not picking up your calls, seller is not able to meet, you are not able to find the sellers, you don't know where the hell the seller is hiding in this entire world, and it's all because of the losses. This 15 rupees is a small loss because this is on one share. If you would have entered into a contract on, let's say, 1 lakh shares, this is nothing but 1 crore 50 lakh rupees. Oh, sorry, 15 lakhs. On 1 lakh shares, it's 15 lakh rupees. On 1 crore share, it will be 1 crore, like 15 crore rupees. At that time, anyone would want to hide from you because no one wants to pay this 15 crore rupees as a loss. So this is a possibility in this contract. What is the possibility in this contract? What is the problem in the forward contract? The problem in the forward contract is there is a default risk. Please understand one more time. There is a default risk. That means a buyer or the seller, whosoever will be facing the losses at that time, can default. See, one more possibility that can happen is this. If the actual market price goes to 107 rupees, what will happen? You will be the buyer at 130, seller at 107. That means there is a loss of 21 rupees. Do you agree with this? And he is the seller at 130, buyer at 107. He will be at a profit of 21. So in this case, the seller is winning the game. In this case, the seller is winning the game. In this case, buyer won the game. But whosoever will be facing the losses can default at the end, and that's why we need certain arrangements for that. Forward contract has one drawback. Parties can default to avoid losses. What is the solution to this then? What do you think is the solution to this? This is where solution. Let's write down. Add a guarantor who can guarantee the settlement even if one party If a party defaults. Just imagine adding an intermediary between both of you who is giving you the guarantee, giving both of you the guarantee that if he is going to default, I will settle the transaction with you, I will pay you the losses to you, I will bear the loss. If this party is going to default, he is giving this guy a guarantee that I will give you the profits to you, the losses to me, the profits to you. So he is taking the entire guarantee for both of this, for the transaction between both of these guys. Obviously, why he will go? He is going to take the losses. This is called as the intermediary. This is called as the intermediary, and this is nothing but exchange. Exchange like BSC, exchange like NSC. Now, these contracts which were, understand, these contracts which were entered into between two parties just by sitting on the either side of the table at any place in the market will now get entered into only on the stock exchange after introducing the intermediary. Now this will be called as an exchange traded contract. This contract will now be called as exchange traded contract, and its name is nothing but the futures contract. And now we need to discuss about what exactly is the futures contract. Let's have a look. Now let me tell you a couple of things. Everything that you learned in the forward contract, this entire transaction is similar in the futures contract as well, except for few things that you need to understand. That what is exactly the difference in the forward contract and the futures contract. The purpose is same in both. The asset will be same, the quantity will be same, the price will be same, the time will be same, but there will be a third person also in the futures contract. In the forward contracts, there was only buyer and seller, and because of the fact that these parties can default, we had to introduce one more party to this, which is the intermediary, which is not a buyer, not a seller, but just a guarantor to this contract. Now, what is going to happen in the futures contract? There will be a buyer, obviously, there will be a seller, obviously, and there will be one more party, which is going to be stock exchange. Okay, this is buyer, this is seller, and this is going to be the stock exchange. Stock exchange means derivatives exchange, we can say. Now have a look. What is going to happen? This buyer will come. Earlier in the forward contract, buyer was going directly to the seller and seller was coming directly to the buyer, and both of them were entering into a contract with each other. Now buyer will go to the stock exchange, the exchange, and the seller will also go to the exchange, and both of them will enter into a transaction with each other. It's the responsibility of the exchange that this contract gets matched with the buyer and the seller. If there is no seller, exchange cannot enter into a contract with the buyer, and if there is no buyer, the seller cannot enter into a contract with the exchange. Simple. So the frequency of buyers coming to the exchange and sellers coming to the exchange is so much that immediately and very frequently, we can say, the contract gets executed. When the buyer says that I want to buy, exchange is like in minutes, in seconds, it gets executed, the contract gets executed. Why? Because the seller is available in the market, sitting at any point of time, any point in the entire country. So this happens. In the futures contract, it is not necessary that the buyer should know who is the seller. It is not required. Seller is also not required to know who is the buyer. It's all about the exchange. Exchange is saying that I am selling you the contract. You are the buyer, I am selling you the contract. And exchange will say to the seller as well that I will buy it from you. You are the seller, I will buy it from you. Now what happens is the entire risk of default that could have happened between buyer and seller is now taken by the exchange. Remember this thing. And for that purpose, exchange is going to ask for a deposit in the beginning whenever they are going to enter into a contract with anyone, with the buyer also, with the seller also. I told you in this forward contract example that if there is a loss to the buyer can default at the end. If there is a loss to the seller, in this case you can see 15 was the loss to the seller can also default. So there is a possibility that both buyer and seller can default, and that's why because there is a risk now to the exchange. If the buyer is going to default, risk is borne by the exchange. Seller is going to get the contracts honored by the exchange. So there will be a loss to exchange in that case. And if the seller is going to default, there will be a loss to exchange in that case, because the buyer will get the contract honored in any case. So in that case, to avoid the loss, exchange is going to make sure that it takes deposit from the buyer and the seller as well. So what is going to happen? The buyer will pay and the seller will pay the margin. This is called as margin. It is nothing but the deposit. You remember one thing, when you go to a hostel, when you take an admission in the hostel, what happens is that apart from the hostel fees, you also have to deposit a couple of months rent to a particular hostel. Even not just forget about the hostel. If you go on a go to stay on a rent, if you take a room in particular city, in Kota, in Delhi, in Mumbai, wherever, if you take it on a rent, you have to pay some deposit. Why the deposit is taken by the landlord? It's very simple. The fact that if tomorrow you destroy the property of that landlord and then run away, then what is the landlord is going to do? It's a loss to him. That's the risk that he is bearing from the moment you have entered into his house, right? So what happens is that it is very much important that the person who is bearing the risk should take the deposit from the other person. So that's why in this case, exchange is bearing the risk of a default, and that's why the buyer has to deposit a margin and seller has to deposit a margin. There was no concept of margin in case of forward contract. So one of the difference from the forward and the futures is that there was no intermediary here, there is an intermediary here. There was no margin in the forward contract, there is a margin in the forward contract. Now, understand, the buyer and seller are an individual. They can do a transaction in any of the asset. Even if I tell you this is the tissue paper, this tissue paper, you and me can be a forward buyer and seller, and we can enter into a forward contract on this tissue paper that you are the buyer, you are going to buy 2 tons of this tissue paper after 3 months. That can happen, and I am ready to sell it at a particular price. This happens in the market, okay? But now let me tell you one thing. Stock exchange is handling the transaction of all the people in the entire country, and it's the only person, or we can say only entity. And on stock exchange, all the assets are not available for futures transaction. The transaction is same, purpose is same, everything is same. But in forward contract, you can enter into a contract on anything. You can create a derivative contract on any asset. But on exchange, that means on futures contract, there are limited set of assets: equity share, commodities, we can say index, currency, limited things. You won't find a futures contract on tissue paper on exchange. You won't find that. But as a person, we can enter into a forward contract in that. So when it comes to asset, forward contract has no limit. But in case of futures contract, there are only limited assets. One more difference. Okay. Another difference. In the forward contract, since we two are only the buyer and the seller, we can enter into a contract on the tissue paper also, or on any kind of equity share also, in any number. Like if we both can agree to buy and sell 5 shares as well. But understand, exchange is being run by a lot of people. It's an entity, it has its own expenses, it has to manage the system infrastructure for all the transactions to happen automatically. Okay, so in that case, it will be very costly for the futures contract and exchange just to create a contract of 5 shares. So what happens in exchange is that they set a minimum quantity for every type of futures contract. If it's a ICICI bank stock, there will be a different lot size. If it's a stock of Reliance, there will be a minimum quantity for that also. So for every asset, there is a minimum quantity that you need to buy and sell. So it is called as a lot size. One lot is equal to the minimum quantity that is required to be bought and sold on the futures for that stock, index, commodity or currency. That is the minimum, and then you in multiple you will have to do that. I will just show you on the board right now after a moment. So this is again another difference in the futures contract. In the forward contract, you don't have to think about the minimum quantity, but in the minimum quantity is fixed in the futures contract. So these are some basic difference which can be asked for 4 marks in your exam. So that is what is necessary. See, I will just show you few more differences. Let's go to the theory book. I think volume number 3. In volume number 3, if we go to the derivatives chapter, let me just tell you the page number. It's 131. So there are many differences. You can see 9 to 10, 9 differences. First, I will just show you few things. See, first of all, trading. Trading of the forward contract. Trading of the forward contracts are on a personal basis, are on telephone or otherwise. We can say over the counter, OTC market. Over the counter means on the one side of the table a buyer is sitting, on the other side the table a seller is sitting. In the center the table will be there. So that's why we call it as over the counter. What happens in the futures contract? They are traded in a competitive arena which is called as exchange traded. Okay, size of the contract. I told you there is no specific size in the forward contract. These are individually tailored and no standardized size. But there is a standardization in terms of futures. Minimum lot will be fixed for everyone. Okay. This is over the counter market. That means it is traded in the over the counter market. This is exchange traded. Settlement. It is same for both, but yeah, in futures also you need to understand that daily settlement happens. I will talk about it. Settlement in case of forward contracts takes place on the date agreed upon. In the previous example, I told you that after 3 months we are going to buy this Adani Enterprise shares. So settlement will happen after 3 months itself. But what happens in the futures? In futures, every day, please understand, every day's price matters. Today it's 100, tomorrow it's 102 rupees. So at 102, your contract will get settled. At 104, your contract will get settled. At 105, your contract will get settled. So what happens in the futures is daily settlements happen in the future. That's one of the good thing that I will talk about. Okay, forget about the delivery date, transaction cost, marking to market. This is the process of daily transaction settlement. These are not subject to any mark to market because daily settlement is not there in the forward contracts. So there is no marking to market. But there is a marking to market in the futures. I will talk about it. Margins. There are no margins. I told you there is no margin required in the forward contract, but yes, it is required in the subject to maintain margin as decided by the exchange authorities. Credit risk. There is a credit risk borne by each party. In futures contract, transaction is a two-way contract. See. Hence, the parties need not to bother for the risk. That means there is no default risk in the futures contract, but there is a default risk in the forward contract. I will show you more about the futures contract now on this platform. This is my stock exchange broker, which is the Sher Khan. This is a trading platform where I have my account since 2014 itself, like I think long back. So let's talk about it. See, I will show you. If you go to the trade now tab, there are few things: NSC, BSC, NSCFO, NSCCURR, MCXCURR, MCXFO. Now what exactly are these? These are the platforms. Okay, if I go to the National Stock Exchange platform, this is the exchange at which I can buy the share. This is the Bombay Stock Exchange at which I can buy the share. Okay, so let's see some things on the ICICI NSE platform. So when you type ICICI, you can see the share is you can get the details of that share. Now you can buy ICICI Bank share from NSE, okay, at 838 rupees. Today is Saturday, so the market is closed, so you won't find much of the change in the prices right now. But it keeps on changing every second and a two. So ICICI Bank share can be bought at 838 at NSE. If you want to buy from this stock exchange, you can buy from this stock exchange also. The price is almost similar. You can decide from this place that if you want to go for buy, sell, or short sell also. I'm just skipping these parts right now, not required as such. If you remember in portfolio management chapter, you learned about what is short selling. Without owning the stock, you can short sell. If you own the stock, and then you can sell it directly. If you want to buy it, you can buy it. Now you can see you can buy 5 shares as well here. 5 shares, any number of share, but not in decimals. The price is this, and rest of the things we are not discussing right now. Okay, so this is also another stock exchange which is called as Bombay Stock Exchange. You can buy the shares from that part also. Okay. Now comes the NSE-FO. NSE-FO means NSE Futures and Options. So this is a derivatives platform. This is called as the derivatives platform. This is the derivatives platform. This is the derivatives platform, and this is the derivatives platform. For currency derivatives, this is NSE currency. Okay, just forget about. I don't want to activate the commodities right now. So if I go into NSE currency, I can buy some currencies. That is a derivative contract that we will discuss in the Forex chapter. But right now, let's focus on the futures and options. Okay. Futures and options are exchange traded contract. Now, let me just go back and to this point where I told you that there are 4 different types of transactions. See, forward contract are traded on OTC market. That means out of the exchange. And this is traded on exchange. This is traded on OTC market. This is traded on exchange. And this is also traded on exchange. Swaps are also OTC market. So these two, futures and options, are traded on stock exchanges, right? So that's why we call it as futures and option. The name is only for futures and option. There is no forward and swap in that. Okay. So first we started the discussion of futures. So let me just tell you that there are 3 different options in this, particularly futures, call and put. This call and put are a part of options contract, which we will discuss later on. Let's first go with the futures contract. Now, once I have the option selected that I want to trade in the futures, I will have to select the security, which stocks future I want to buy. So let's say ICICI. If I select ICICI, let me see, yeah. The moment I select ICICI Bank, you can see there are 3 different contracts available for the ICICI Bank. Let me just type the entire name so that only required things are visible. Okay. So ICICI Bank 25th August 2022, 29 September 2022 and 27th October 2022. Okay. So what happens is that at any point of time, if you want to deal in the stocks future of the stocks, not index, not currency, and not commodities. If you want to deal in the equity future, we can say equity future or the stock future, there will always be 3 coming contracts which are going to expire on 25th of August, 29th of September and 27th of October. These days are nothing but the last Thursday. Understand my thing, whatever I'm saying. These days are nothing but the last Thursday of the coming 3 months. So right now, the time that I'm recording this class is 6th of the August. Okay. So that's why the first month is the August itself. The last Thursday of this month, last Thursday of the next month, and the last Thursday of the next to next month. At any point of time, three different contracts of this on this ICICI Bank for futures will be available. You have to decide whether you want to buy the shares of ICICI Bank in the coming 3 months or not. If you want to buy the futures of like say 4th and 5th month, then you will have to wait for the first month to get over. The moment 25th August gets over, this contracts will be removed from this list and a new contract for the last Thursday of November, understand, last Thursday of November will get introduced automatically. So at any point of time, there will be three contracts active on the equity stocks for future. Not just one, not just two, but three contracts for the coming 3 months on the last Thursday. This is what happens is on the last Thursday, every futures contract in the stocks gets equity gets expired. So let me select you the nearest month futures. Now, what I have selected, please understand and try to read it. This will be applicable in your practical life also. This is ICICI Bank futures, which is going to expire on 25th of August 2022. So what does that mean? I can buy or sell it today and I can cover up the entire transaction or close the transaction anytime on or before 25th August. If the expiry is 25th August, that doesn't mean that I cannot close my position on tomorrow. It's tomorrow or the day after tomorrow or the day after tomorrow. Anytime before 25th August, I can close my transaction. I'm buying it right now. I can close it after 1 hour also at whatever the price going on. Okay. So this is the maximum date that this contract will go on. After that, this contract will get removed forever. This date is not going to come back. Okay. And your contract with the exchange will also get over. This 25th August 2022 bank's future is available at 835.55. So price of one equity share is 835.55. It's not today's price. It's the price estimated for 25th August. Now understand, if I go back to NSE and I type ICICI Bank share, you can see the current spot price is 838 rupees. Okay, let me just take it to this calculation. It's going to be an interesting part now. So if you go to the cash market or the spot market, you can buy the ICICI share at 838 rupees. But today itself, if you go to the futures market for like 25th August, right, this month's last Thursday, and again I have to type so that is available at 835.55. What does that mean? That means the market is expecting, no, sorry, not here, it should be here. It means the market is expecting that in the coming 20 days before 25th August, the price of the futures will go down by around 2.5 rupees. They're not expecting it to grow. So if you are sure about, please understand, if you are sure about your expectation that the share price on 25th August, on or before 25th August, can go beyond this price, let's say 840, then I would suggest you to go and buy the futures, because if in reality the price of the share on 25th August becomes 840, then you will be at a profit, because you are buying the futures. You are fixing the price of ICICI Bank on 25th August as 835. That means you are buying it, and if you are buying at this price, the actual price goes to 840, then that means you will be at a profit of 4.5 rupees. What happens at the maturity? As the maturity gets closer, the spot market price of the share and the futures price of the share gets closer. So on the expiry, the price of the share of both the markets will be same. You have purchased at this price, you will be selling at this price, there will be a profit of 4.5 rupees on every share. Now understand the difference. You cannot deal in one share only. There is a minimum quantity, 1375. You can clearly see that 1375 is a lot size. See what happens when I try to change it. Let's say I want to deal in only 45 shares. What happens? See, there is a message. Order quantity cannot be less than 1375. That means minimum this much of the quantity I will have to deal in. What happens if I go one more share above that, 1376? Just have a look on the message that they are presenting. Order quantity must be in a multiple of 1375. So 1375 is one lot. You can decide on any number of lots that you want to buy. 1375 into 1370 plus 1375 plus 1375 and so on, but not in between. Other thing that you can do is you can buy the futures, you can also sell the futures. It's not necessary because it's a contract. You can be a buyer of the contract, you can be a seller of the contract. You are not dealing in the asset, so you don't require to have this asset at present. You can just enter into a sell contract. That means you are selling at 835 rupees. Do it only when. That means you are selling at 835 rupees. That means you are saying that the market price of this share on that date will be much lower than 835. Only then it will be beneficial for you to sell it at 835. Selling price should always be higher. And if you become a seller of this future at this price, it means that you are expecting the share price to go down. Why? Because only then you will be able to make profit. If the share price goes down to 820 rupees, you have sold at this price, you will purchase at this price and there will be a profit. Why? Tell me why someone will sell this future when that person is expecting the price to go up? Never. Nobody wants the losses, right? So whatever you want to do, you can buy the futures right now or sell the futures right now, but you will have to deposit a margin with the exchange. Now, you can see if we deal in a single lot itself. So the contract value will be this much, 1375 into 835.55. 1375 into 835.55. Imagine 1375 into 835.55. The contract value, which this will be called as a one contract value. This is nothing but the lot size. This is nothing but the lot size. This is nothing but the actual market price of futures. Okay, the contract value will be 11488.25. 1881.25. 11,48,881. Sir, does it mean that we have to pay 11,48,000 rupees to buy one lot of ICICI futures? No, you don't have to pay this much of the amount. I told you, you are not actually buying the shares. So stock exchange is also not requiring or asking you this much of the money. They will just ask you the maximum possible loss that can happen in this before 25th of August. So what is exchange going to do? Exchange is going to apply its own system, which is called as SPAN, SPAN. Okay. They will apply their own system and they will find out the maximum possible loss. If you have heard about it in the risk management chapter, VAR, value at risk. So whatever the maximum possible loss can be, that will be the margin money. So let's say, for example, 25% can be the maximum possible loss in this lot before 25th of August. Okay. Now what is going to happen? 11,48,881.25 into 25%. You have to deposit only 287,220. By paying this much of the money, you can create a position of this much amount. And these figures are actually big and like decimals are also covered in here. What I will do is I will just explain this concept to you with a simple example. Come over to this point. This is a spot market and this is a derivative market. So let's first discuss about the spot market. Let's say, for example, you want to buy the stock. In spot market or cash market, whenever you buy the stock, you own the stock. You actually want the possession of that stock, the ownership of that stock, right? So if the stock is worth 100 rupees, your cash outflow will also be 100 rupees, right? And after a year, you can sell it at whatever the market price is. Let's say the market price is 120 rupees. So cash inflow will also be 120 rupees. In actual, you can clearly see here the return, if you want to calculate, is nothing but the return is nothing but 120 minus 100 divided by 100. That's 20%. Am I right? The cash flow that has happened from the beginning till the end. You paid 100 rupees, you received 120, 20% is your return. Now what happens if we buy the future of the same stock? Not the stock in reality, but only the future. Let's come to the derivatives market now with the same stock, same price. Okay, practically this price will be little different, but let's assume it for the sake of understanding. If you are buying the futures of the same stock, let's say the stock was Adani Enterprises and you are buying the futures of Adani Enterprises. In this case, you were buying the stock of Adani. In this case, you are buying the futures of Adani. The difference is that you get the ownership of the stock or ownership of the Adani Enterprises here, and you don't get the ownership here. It's just a contract that you are entering into with another person for a limited time. That is 2 months, 3 months, 1 month. Okay. So if you buy the futures of Adani Enterprises worth 100 rupees, you don't have to pay the entire amount. The cash outflow at this point of time will only be the initial margin. Let's say that initial margin is 25%. That will be calculated by the stock exchange using span system. Okay, that 25% only will be paid by you to the stock exchange as a deposit. So the cash outflow will only be 25 rupees. And if the market price goes after a year or after 3 months, let's say the market price goes to 120 as it went into this example. Okay. What will happen? Are you going to get 120 rupees? No, sir. There is no concept of cash outflow or inflow at this price. We will get our contract settled. The cash inflow will only be the margin amount that you paid plus and minus the profit and loss. What the exchange is going to do is this much. What they are going to do, they will calculate your profit or loss. In this case, there is a profit to you because you have agreed to buy at 100 and today the selling price is 120. So practically there should be a 20 rupees profit to you. What the exchange is going to do, in your previous balance of 25 rupees, they will add the 20 rupees of the profit on this futures settlement. This will be called as the settlement of the futures contract. And then they will give you back 45 rupees. So practically your investment was 25 and your inflow is 45 received. Now what is the return? In this case, if you want to go and calculate the return, it's very simple. 45 minus 25 divided by 25, and that's around 20 divided by 25 into 100, 80%. See, you can clearly see in both the markets the return was same. In this case also the return was 20 rupees. In this case also the return is 20 rupees. But the investment was much higher in this case. And the investment in this case is much lower. So you can clearly see that. See, just an example. If you had 100 rupees, you could have bought one stock only and the return would have been 20% itself, 20 rupees, right? But if you have 100 rupees in this case, you can buy 4 lots of, because 25 is only required to be paid for one lot, you can buy 4 times the futures. And the profit will also be 4 times. In that case, your profit will be 80 rupees on 100. The percentage will be same, but the amount will be 80. By investing 100 rupees in the spot market, you earned 20 rupees only. But by investing 100 rupees in the futures market, you earned 80 rupees. So which market is better? Sir, both the market are still better because you don't know the other side. I am telling you the profits, the losses will also be same. If there is a loss of 20% in this market, then you will lose only 20 out of 100. But if there is a loss of 20% in this market, you will lose 80 rupees out of 100. If the profit is 80%, the loss can also be 80%. So yes, this market is very much attractive, but at the same time, very much risky as well. Do you get that? Do you get that? So you need to be very careful. Okay. There are a couple of advantages and disadvantages. You can get a more contract value in derivatives market. There is a possibility of higher return in the derivatives market for a limited period. There is a possibility of lower return in this case, but for a longer period. Okay. One more thing, you get the ownership of the stock here. You don't get the ownership of the stock here. You get the leverage benefit here because you can buy a much higher value contract. You can enter into a higher value contract by paying a lesser amount. But in this case, whatever the contract value is, that has to be paid by you. So that's a disadvantage to you in this case. So you can take the leverage benefit here. There is no leverage benefit in this case. This is riskier as well. This is less riskier. So this is what the spot market and the derivatives market is. Forward and futures is, initial margin is. There are lots of concepts that you have learned. The lot size, minimum quantity, and so on. So yeah, obviously it took a lot of time for the initial discussion, but I think this is very much required before starting the question. Okay, one more thing. If you are hedger means you wanted to buy the stock in reality. See, let me just come to the main point. Yeah. Again, I'm telling you the same thing. If you really want to buy the stock at any point of time, you will still have to go to the spot market itself. The future market can only be used for reducing the losses that might happen in the spot market. Today the price is 100 rupees. Maximum that you can buy the share is ready to buy is 130 rupees. So if the market price goes to 145 on that date, what will happen? You will pay 145. See, you will pay 145 in the spot market and you will get a profit of 15 from the futures market. So ultimately you will be paying 130 only. But that 130 will go in these two different amounts in different markets. This is a derivative market settlement, 15 rupees of inflow. This is a spot market settlement. So this way you paid only 130 rupees and you are still the owner of the stock. But if, just understand, if the market price goes to 107, okay, you will pay 107 on that date to buy the stock, and you will also pay 21 rupees in the futures market. So that will again cost you 130 rupees. That is what the disadvantage is. But obviously if you are the hedger, see, if you are the hedger, that means you don't have a purpose of profit. You don't want to earn profit. You want to fix the price today so that there is no risk. And in that case, if the price is 130 here also and here also, that means your purpose is solved. You wanted the price to be fixed. We have fixed the price. If it is lower, you will have to pay more. If it is higher, you will have to get the refund. Ultimately, your net cash outflow won't go beyond 130. So in that case, what happens is, in the beginning itself, the hedger knows that now whatever the price will be on that date in the spot market, whether it is 145 or 107, that doesn't matter to me, because today I have fixed the price of that. And on that date, I will have to in any case pay 130. So that's what the hedging is. But if your purpose is the speculation, that means you just want to play on the prices of the futures. That means there is no picture, there is no spot transaction or actual buying or selling of the share in the spot transaction. This picture won't come into the scene. So what happens in case of speculation is this does not happen. Nobody buys the share or sells the share in reality. They just buy the future contract and sell the future contract, settle it, and get 15 rupees of the profit. If the market price goes to 145 in the spot market, they will get a profit of 15 rupees in the futures market. If the market price goes to 107 in the spot market, they will have to again pay 21 rupees out of the margin in the futures market. So in the futures market, when it comes to speculation, this is the only one transaction that happens, which is the settlement of the futures. But if you go to the hedging, if you are a hedger, then these are the two transactions which is going to happen. So this is what happens with the hedger and this is what happens with the speculator. Do you get that? We'll talk about it. We'll talk about the arbitrage later on. So this is all the meaning of the forward and futures contract. Let me just take you from the very beginning to the end. Derivatives analysis and valuation we started. It is nothing but a contract between two parties to buy or sell certain asset in certain quantity on certain future date at a certain price. Everything is certain. That means fixed and known. Okay. Now, this is nothing but the derivatives. This contract is called as the derivatives. It can be a forward contract, futures contract, options contract, or swaps contract. Forward and swaps contracts are over the counter market traded. Futures contract are exchange traded, right? Then quantity is fixed, which is the lot size. The buyer will be called as the forward buyer or the futures buyer. The seller will be called as the forward seller or the future seller. What they are actually buying or selling is not the stock. Please, it's not the stock. They are actually buying or selling the contract. Okay, this future date will be the expiry date. Please understand one more thing. Expiry date is the final date on which the forward contract is settled, but the futures contract can be settled on or before the expiry date, on or before the expiry date at any point of time. So it is not necessary that you stick to the expiry date and then you can only end the contract at the expiry date itself. You can end the contract before that also. Okay. When it comes to the asset which can be traded in the forward market and the futures market, in the forward market you can trade on any type of asset. I told you that the newspaper can also be traded in the forward market. But what happens in the future market is it is limited asset. Equity like TCS, Reliance, Tata Motors and ICICI Bank, index Nifty, Bank Nifty, etc. Commodities, gold, silver, bajra, rice, etc. Currencies which we will talk about in the forex chapter like USD, Euro, Yen, Canadian dollar, etc. On all these assets, futures contract can be bought and sold between two parties. Okay, I told you the logic of the forward contract, what exactly happens in the forward contract, but there is one drawback in the forward contract, that both the parties can default if it comes to losses at the end, and that's why we need a guarantor in between. And that's why what happens is that this guarantee is taken by the exchange, and then the forward contract's name is changed to the futures contract. What happens in the futures contract is there is a buyer and seller, as we have seen in the forward contract, but there is one more party which is called as stock exchange, or we can say exchange. Now the buyer and seller need not meet with each other to enter into a contract. Buyer will go to the exchange, seller will go to the exchange. Both of them, buyer and seller, may not know each other, but still they can enter into a transaction with the exchange, and it's the responsibility of the exchange that the contract of the buyer gets matched with the contract of the seller. But obviously, since the risk is being avoided now by the buyer and seller, the risk is being taken by the exchange, and for that risk, the buyer is required to pay margin, seller is required to pay margin at the beginning of the contract. What happens at the end, whenever buyer is going to close the contract or seller is going to close the contract, exchange will calculate the profit or loss, and then it will add or less in the margin, and the balance margin will be paid back to you. So if you have a profit, you will get higher amount of margin. If you have a loss, you will get lower amount of the margin. So ultimately the margin is being settled. Got it? So this is what the forward and the futures contract is. I will take a break and I will be back with certain more concepts. See you. Okay, so welcome back everyone. Let's start with the practical questions of the derivatives. What is going to happen now? Let me tell you very clearly. With the question itself, we are going to see lots of concepts. Okay, so in the question, while discussing the question itself, we are going to discuss lots of concepts, and I will explain you a few things with the examples as well. Let's start with the practical part. So in volume 2, you have to come to this page number 1. Derivatives analysis and valuation. We have this first question. This first question is mostly based on hedging concept, the concept of hedging. Now let me just take a minute and take you to the concept sheet, and if you will see here in the concept sheet, we have this derivatives analysis and valuation, where we'll be learning about all these concepts. What is short and long position in futures? What is the forward pricing item? Then what is contango, backwardation, forward pricing, initial margin, mark to market. Then you will learn lots of things about the initial margin, mark to market, open interest, arbitrage, again hedging, again hedging. There are lots of questions for the hedging. Then profit and loss on option settlement, hedging with the options. Then from this point onwards, I think options options will start. So option, and there are lots of questions in that. Okay, so all in all, what I will say is that the number of concepts are less, but every concept will have to be understood by us in detail. and carefully and slowly. Okay, let's come to this question. Now, this is a chapter where I would say that it's better if you go through the class first rather than doing the question by yourself, because I will be explaining the concepts along with the questions. So you need to listen to me first for those concepts, right? But I will tell you, apart from this chapter, it's very much important that you do the you watch the concept related video first and then do the questions by yourself and then come to the class apart from this chapter. Okay, okay. Which position on the index future? Now it's asking about the position. There are two types of position in the market. You can go long, you can go short. Long means you can buy, short means you can sell. So that's what the question is asking, whether we should buy or sell. In a technical term, it's a long or short position. Okay, now what is this index? Index can be Nifty, or we can say bank Nifty if we want to particularly find out about a segment or an industry. That will be bank Nifty, like this. Now if you go to this platform and in the NSE futures and options segment, if you select the futures and then type Nifty, you will see lots of Nifty related options. See, futures. Options means I didn't mean the option segment of this. So there are multiple options with you, choices we can say. So Nifty, these Nifty contracts are available. So this is called as index future. This is index. This is in the segment of future. Let's say if we select Nifty for 29th September 2022, if you buy this, it will be called as you have purchased the index future, not the stock future. When you go for the ICICI now, that is called as equity future or stock future. This is called as index future. Okay, now have a look. Which position on the index future gives a hedger? Hedger means a person who wants to reduce the loss or altogether avoid the losses. Now the question is, hedger is a person who might be having some position in the spot market, and in order to avoid losses on that hedger wants to take some position, whether long or short, on the index future. Now the question is, why index future? I will tell you one thing. If you have purchased in the spot market, if you have purchased, let's say, the stocks of Tata Motors, okay, then you can hedge this stock in futures market by purchasing Tata Motors futures, right? So you have the option in the stock market. Just a second. Now, too much. Okay. So if you have a position in the spot market that you have purchased the Tata Motors shares, and then you are like afraid or you're scared of this stock going down, what you can do is, if you have purchased this stock, you can sell the Tata Motors future. So what will happen if both the stocks goes down? If the Tata Motors spot price goes down, the Tata Motors futures will also go down, and this loss will be covered by this profit. Because you have an opposite position in both the market, there will be a profit in one case and the loss in another case, because both the shares are of Tata Motors, right? Let me just give you an example and then I will be back to the question. Let's say you have a spot market position of Tata Motors, right? And then you have that is for 100 rupees. Let's do that. And now the main problem is that you are scared that this price will go down in another 1, 2, 3, 4, 5 months to 70 rupees. So that will cause you a loss of 30 rupees. If you don't do anything, if you don't take any action, this 30 rupees of the loss is confirmed if the stock price goes exactly according to your expectation. But this 30 rupees of the loss can be avoided today itself. And not by selling this Tata Motor share. What you can do instead is, in order to hedge means to avoid the risk of loss, you can use the derivatives market now. That is why we are taking this chapter. So in order to avoid losses on this, you can take the position in the futures. Now what you can do is, you can enter into a Tata Motors futures contract. And what exactly you have to do, I will tell you. If you have a long position in Tata Motors in the spot market now, you take a short position in the Tata Motors futures. Why, I will tell you in a moment. Okay. And let's say, for example, you have taken a position of 100 rupees of the Tata Motors futures. And then if in reality the stock market goes down to 70, this Tata Motors shares goes down to 70, this futures will also go down to 70 theoretically. And what will happen? You have sold the futures at 100, you will be buying it back at 70, and there will be a profit to you of 30. So by the end of the 5 months, you will have no profit, no loss. You will have no profit, no loss. Although the share would be trading at 70 rupees, but you will still get 30 rupees from the futures exchange. So practically it's okay to you, even if it is at 70, because 30 rupees has been encashed by you from the futures market as a profit. So that's when you can say that I have hedged my portfolio. Okay, that's okay. Now let me tell you one thing. Suppose the futures of Tata Motors is not available in the market, or let's first find out, but it's better to go with the real data than, see, you can see in the futures and options segment, you have a Tata Motors shares, right? So Tata Motors futures is available in the spot market also, in the futures market also. So it's very easy for us to do the hedging. We are actually hedging a position here with the help of the derivatives market. But what if you are holding some kind of a share here which has no stock, which has no option in the futures and option segment, which is not there in the futures? Yes, sir. I will tell you one thing. In the cash market, there might be 5,000 securities which are traded. But for all the securities there, the futures is not available in the futures and option segment. Okay, let's find out a company named let's go for Nykaa. Yeah. So you can clearly see that we have a share of Nykaa in the NSE segment. Okay, let's find out the same in future segment. Do we have a futures of Nykaa? Let's just find out. See, there is no futures available of Nykaa. Is it available? Not available? Right. Now, let's change the stock from Tata Motors to Nykaa. Let's change the stocks. Let's say you have purchased Nykaa shares. I think it's KAA or double K. Let me just first confirm. I'm pretty much confused with that. Yeah, KAA. Okay. So we have a Nykaa shares worth rupees 100 in our pocket in the cash market, and we are scared of this particular fact that it can go down to 70 rupees in 5 months, and we might lose 30 rupees. In order to protect this loss, what we can do is we can still do the hedging in futures market. Sir, how we will be able to do the hedging in the futures market when we don't have Nykaa's futures available in the derivatives market? Yes, sir, it is still possible. And at that time, what you have to do is you have to go with the index futures. Because there is certain relationship with the Nykaa and market, and that is represented by beta. So at this time you will have to introduce the beta of Nykaa. Let's say beta of the Nykaa is 1.2. Okay, beta of the Nykaa is 1.2. That means if this market, index means what? Index means what? Market. If this market goes down by 10%, Nykaa will go down by 12%. Okay. Now let's change this particular fact from here, and let's take, I told you that we have to take the opposite position, long and short. In this case also we will take the opposite position. For how much amount? Let's say we take it for 100 rupees. We did the same thing in this part, na? Tata Motors 100 rupees, Tata Motors 100 rupees. In this case also Nykaa 100 rupees, index futures 100 rupees. Now one basic fact that you should be clear about is, when you buy the shares of Tata Motors in the spot market or Nykaa in the spot market, you have to pay 100 rupees. In reality, the cash outflow is 100 rupees. But when you buy the futures or short the futures of Tata Motors or index futures or any kind of a future, you don't have to pay 100 rupees at that time. You just have to deposit margin money. But the total position will be of 100 rupees. With 25 rupees or 20 rupees, you can create a position of 100 rupees. That's the fact. Okay. So let's go ahead with this thing. Now, let's say, for example, if the market goes down by 30%, that means the index futures is trading at 70 rupees after 5 months. Let's say, for example. So what will happen to the Nykaa? What will happen to the Nykaa? Nykaa's index beta is 1.2. Can I say one thing? That if the market is going down by 30%, the Nykaa's price will go down by 30 into 1.2%. Exactly. So that's around 36% fall in the Nykaa's price, and that will go to 64 rupees. Now, you had a long position in the Nykaa. That means you had purchased those shares at 100. Now you will be selling those shares at 64, and that's a clear-cut loss of 36 rupees. Am I right? You had sold the futures of index at 100 rupees. You will be buying it back. That means settlement, or we can say we'll go long. And there will be a clear-cut profit because you are buying at 70, sold at 100, and there is a clear-cut profit of 30 rupees. You will see there is still a loss of 6 rupees. Whereas if we go for the complete hedging, if we say that we have achieved complete hedging, then this loss would have been 0 rupees. It should have been 0 rupees. But if it is not 0 rupees, or if it is not 0, we cannot say that this is a complete hedging. And I will tell you one reason for that. You did everything right in this entire equation. You had to go opposite position. You had a long in here. You went short in here. That's totally right. But one mistake you made while taking the amount, like while taking a position in the terms of amount in the index futures. Now, in this case, you cannot repeat this procedure because the share was Tata Motor. It was 100 rupees position for you, and we can clearly say that the Tata Motors relationship with the Tata Motors is 1. The beta in this case was 1. So practically speaking, this 100 in the futures was achieved by multiplying the beta with the spot market. So 100 multiplied by 1 was 100 at that time. That's why the change in both of them were exactly equal, 30%, 30%. But the change in here is not exactly equal. And that's the major reason why you cannot have the same position in the index futures as well. So you need to change this particular position in the index future at the time of hedging. If you have 100 rupees of the position in the spot market, you cannot just have the same position in the index futures unless and until your beta is 1. So if your beta is 1.2, what do you think should be the position in the index futures so that the complete hedging can be achieved? Let's just try it once again. So it's very simple. The cash market position multiplied by the risk that we want to reduce. We want to reduce the entire risk, multiply the beta with entire figure, 1.2. So 100 multiplied by 1.2 comes to 120. Now, practically speaking, you should take a short position in the index futures worth 120 rupees, and only then you will be able to achieve complete hedging. What I will do is I will just make sure that this particular example is maintained for later reference also. I will duplicate this entire scenario in here. Okay. Now, the only thing that we are going to change is this correction of the position. Let's change the position. We said that we need to take the position in the index future, which is the position of the spot market multiplied by the risk that we want to reduce. We want to make this risk from 1.2 to 0. So the risk that we want to reduce is entire 1.2. Okay. So 100 multiplied by 1.2 comes to 120. Take the short position in the index futures worth 120 and now check your calculation. If this 120 goes down by 30%, you will be at a profit of 36. 120, let's say 120 less 30% goes to 84. So you will be buying those back at 84, sold at 120. The profit will be 36, and now we can say that the complete hedging is achieved. This is how we take the position in the derivatives market just to protect the position in the spot market. This is what happens. See, I also have a position in the spot market. You can clearly see I have a position in the spot market worth 22 lakh rupees. That is my investment, and the current value is 33 lakh rupees. And if I have a portfolio created, how I can hedge this portfolio for the next 3 months? I will have to take the portfolio's beta first of all, and then take the index futures. If my portfolio beta, let's say for example, I will tell you, if my portfolio beta comes to 1.5 and the portfolio value was 33 lakh rupees, round off. Okay. And if I want to hedge this portfolio for the next 5 months, I don't want any kind of a losses in that. Then in that case, what should be the action? It's very simple, sir. Portfolio value multiplied by the risk that you want to reduce. Right now the risk is at the level of 1.5. To what level you want to bring it down? To 0. And if you want to bring it down to 0, that means 1.5 to 0, that is equal to 1.5 itself. So multiply by the beta. Wrong. This statement is total wrong. Don't multiply by the beta. Multiply by the risk that you want to reduce. I want to reduce entire risk. Entire beta will be multiplied then. 1.5. So what will happen? 33 lakhs into 1.5. That means I will have to take a position of 49 lakhs 50,000 in the index futures. Obviously, I don't have to pay this much of the amount. I will be taking a short position in that. Why? Because I have a long position in the spot market, first of all. And I will be taking a short position in the futures market. And that too Nifty. Also, one more thing. Do I have to pay this much of the amount? No, sir. I have to pay only the margin money. Whatever 20%, 25% is there, I will have to pay that much only in order to take the position. And in that case, I will be able to hedge the entire portfolio. Now coming back to the question. Too much of the discussion on the first line itself. Have a look. Now, a complete hedge. Understand? Underline this. Complete hedge means beta should be 0. Means there is no risk. Against the following transaction. Now have a look. The share of right limited is going to rise. The expectation is that the price is going up. He has a long position on the cash market of rupees 50 lakhs on the right limited, and the beta of right limited is 1.25. Although you have this expectation that the share price is going to rise, and that's actually good for you because you have already purchased it for 50 lakhs. If it goes up, it's your benefit itself. But if it goes down, then there will be a loss to you. So tell me one thing. Let's take a step back and let me just ask you one last thing. In this case of Nika and index future example, in this case, what would have happened if you would have taken the long position in the index future? Because you have a long position in the Nika, try taking the same position in index future. What would have happened? Purchased at 120, sold at 84, the loss will be 36. In this case also the loss will be 36. In this case also the loss will be 36. At that time, instead of reducing the risk, you would have increased it to double. Like you would have doubled the risk. Why? Just one mistake. You already had a long position in one market. Why to take the same position in the other market? You take the opposite position. That's what is important. And opposite position should be taken when the beta is positive. I will tell you. This is the rule for hedging. If you want to hedge, first find out what is exactly the beta of spot market position. So in spot market, whatever you have, the portfolio, the equity share, whatever you have, what is the beta of that? If the beta is positive, which is mostly going to be throughout the chapter, okay, and the beta can be negative. If the beta is positive, take opposite position in futures. If the beta is negative, take same position in futures. Now I will give you the logic of that, and then only you will be able to understand this. It means in spot, if you have a buy position, then in index futures, you take a sell position. If you have a sell position in spot market, take the buy position here. But if the beta is negative and you have a buy position in the spot market, take the buy position in the futures as well. If you have a sell position in the spot market, take the sell position in the futures as well. This is when you can achieve complete hedging, and I will tell you how with the simple example. Market and stock. Okay, let's say you go long and you go long on both, right? And the beta is 1.2. If the market goes down by 10%, the stock will go down by 12%. And in that case, see, you had a long position, both the markets went down, you will suffer losses, right? Or we can just write it like this. Market, stock, long, let's say if the position in the market is 100 and in the stock it is 100. Let's say for simplicity, let's take the beta as positive 1. So that's why 100 multiplied by 1 is 100 in the market. So if the market goes down by 10%, it will also go down by 10%, 90, and you will have a short position here. You can clearly see that you will have a loss of 10 rupees in each case. Why? Because you took the same position. And once you take the opposite position, let's take the opposite position. Short. That means you sold at 100. If the beta is positive, what is going to happen? Both the market will go down, but you will have a profit in this case. You will buy at 90 because you have already shorted it. You have already sold it at 100. Now you will buy it at 90 since both the markets are going down because of the beta is 1. And if the beta is negative, what happens is that, I will tell you, which will not be the case anywhere, but still institute can ask you anything. Let's say the beta is -1. In that case, it was all +1, right? and minus one means the change is opposite. Have a look. If you take the opposite position now, and if the beta is -1, market is going down by 10%, stock will go up by 10%. Why? Because the beta is negative. So opposite movement will be there. And you had taken a long position in the stock, you will take it short and you will take it long in this case. Okay. Let's do one thing. Let's change the percentage. Okay, let's say the market is going up by 10% and the beta is negative. That means the stocks will go down by 10%, right? So this will be 110 and this will be 90. Am I right? 10% up from 100 is 110, 10% down from 100 is 90. And you are buying at 110, sold at 100. What is happening? 10 rupees of the loss, 10 rupees of the loss in this case also. Why? Because you took the opposite position in the market, index future. See, it's very clear. Opposite position is not the final answer. There are two things to consider while hedging. If the beta is positive or negative. If it is positive, take the opposite position in the stock market, in the index market, futures market to achieve full hedging. If the beta is negative, take the same position. That means long. Take the same position as you have in the stock market, long, short. Then if the market goes up, in this case, you will have a profit. You will now short it at 110. So that means you have a profit of 10. Do you get that? In this way, you can achieve complete hedging. So the rule will be this. First, find out the beta. If it is positive, which will be the case in the entire syllabus, you won't find a beta negative and then doing the hedging. But this can be asked as a something new by institute. Okay. So if the beta is positive, take opposite position in futures. If the beta is negative, take same position in future. For complete hedging. For what? For complete hedging. And multiply the position that you are going to take with the beta. Right? See, what happens is, you need to take opposite position in future. So what should be the amount of this position? It is nothing but the portfolio value multiplied by the risk to be reduced. So if you want to reduce the entire risk, multiply it with the entire beta. If you want to reduce the 50% risk, then multiply it with the 50% beta. The logic is this should be multiplied with the amount of risk that we want to reduce. That will be equal to the position that we need in the futures. Okay, so this is all done. Let's come back to the question. Which position on index future? Let's go back to this. For a complete hedge against the following transaction. The very first, the share of Right Limited is going to rise. He has a long position on the cash market. See, I told you, if you want a complete hedging, first look at the beta. If the beta is positive, take the opposite position. Now, in this part, and in this part, in all the three parts, the beta is positive. Right? So the very first thing that we know is we have to take the opposite position in the futures market. We have a long position here, take short in the futures market. We have a short position in the second part, take long position in the futures market. We have a short position again in the spot market, take long position. That means take the opposite. Short, long and long. That should be the answer. See, short, long and long. Okay. Now, let's come back to the second part. Which position on the index futures gives a hedger a complete hedge? This position on the index future will give him a complete hedge. But for the complete hedging, we need to know the amount. It's very simple, sir. 50 lakhs. Complete hedge means we want to go to the beta 0. 50 lakhs multiplied by the risk that we want to reduce. From 1.2 to 0, we want to reduce it to 0. So the answer is 1.2. 50 multiplied by 1.2, 25. Then 25 lakhs multiplied by 0.90 minus 0. 0.90. What is this 0? The new risk that we want to achieve, that is 0. And 20 lakhs into 0.75 minus 0, 0.75. It's as simple as it is. So 50 lakhs multiplied by 1.2, 25 lakhs multiplied by 0.9 and 20 lakhs multiplied by 0.75. Multiply. And your answer is ready. All in all, this is the position. You have a this does not matter. First of all, instead of that, I think we should have a position related column: long, short, short. See, if we have a long position and the beta is positive, then take the short position. Opposite: short, long, short, long, right? So how much of the short position is required in the right limited? You take the 62,50,000 rupees of the short position in index future. In index future, simple calculation: 50 multiplied by the risk that you want to reduce. Instead of beta, we will say risk that we want to reduce. That will give you the position that you should take a short position in, that is 62 lakh 50,000, then 22 lakh 50,000 long position, 15 lakh long position. If you do the total of all these three, it comes to 25 lakh rupees of the net position for all this two, and that too short figure is higher, right? So this is what the first question was. I know we have taken a lot of time to solve the first question, but I think we have discussed lots of things till now. Okay, so I will just take a break and I will be back with some more concepts in order to solve question number 2. We are going to focus now on the arbitrage related activities.